Hey everybody, welcome to Trading Capital's live stream of the FOMC meeting, which makes me think we're actually going to get a pop into the actual FOMC and then maybe a reversal. So typically you don't want to trust the initial pattern, but right now it is looking like there's a potential head and shoulders. There's a gap fill up here that I'd love to see the market pop into, and then we can exercise a short. That's kind of what I am looking for on the SPY. The regionals are very, very extended on the daily chart. I am intrigued about shorting them here for a large day trade because we have had a pretty decent move up off of the lows. And if we do get another rate hike, it should impact their net interest margin. So I'm watching that specific banking sector closely, the regionals. And then I also have Teladoc on the radar, Google as well, IWV, the cloud stocks. So we'll just have 4 minutes till the next rate hike. Right now, the dollar is slightly negative on the session. The IWM indices up 0.39%, actually holding up the best. And then the SPY ETF is up just a quarter percentage point, and then the NASDAQ is down the most out of the indices. So clearly, big cap, mega cap tech is seeing some pressure today, specifically on Microsoft, even though Google's up nicely on the session, about 6%, 5.5%. You have to really factor in that Microsoft is a larger weighting in the overall indices. All right, so we've got NIO falling, triggering this potential inverse. This is a short play down to 1262. We will see if that fulfills its pattern. The SPY ETF is trying to catch a little bit of a bid here. Whole cluster of moving averages. This key breakdown zone, you broke down once, twice, but it makes me think we want to pop up in gap fill. So NIO is now trending lower. So right now yields are sitting at 4.9. With the Fed raising today, it takes it to 5.25 to 5.5 on the Fed fund rate. And that would mean a new high in the rate, despite inflation sitting around that 3% range mark. So I'm looking to potentially short this market just due to how extended we are, but let's wait for this reaction. There will likely be a big pop and then a drop, or there likely going to be a big drop and then a bounce. The dollar is trying to creep up, sitting at that 101.25. We will see if we can execute any winners. We were caught the whole NIO trade on the long side. Our members banked quite a bit. You can find out more information about our TC Trading Capital membership on our website at tradingcapital.ca. Nothing here is financial advice. It's just simply what we are doing with our own capital. Right now I'm seeing the VIX pretty much down in the session. Nat gas is getting a pop. Oil's basically flat to negative. I'm seeing Bitcoin, seeing a little bit of sell side pressure, but it is up on the session. Apple's been holding strong, Nvidia weak, Microsoft weak. So it's really those cloud computing stocks. Let's see what we get here. We have 2 minutes to showtime. 2 minutes to showtime. No real move in the yield market, still sitting strong at 4.91. If the Fed raises, we will see if this starts to taper off, because that could mean the bond market signaling the Fed coming to the near end of their hiking cycle. Right now it's in a very strong technical uptrend, so you would favor more potential upside in the yields, but it's really going to be dependent on inflation. So I'm looking to trade NIO. We're starting to see some volume coming in a little bit here. I'm looking to maybe short the spiders on a pop, or if we trigger this head and shoulders pattern, which takes us down to about 451.27. You have your left shoulder, you have your big head here, and you have your right shoulder. It takes you down to about 451.57 on the chart. Is it going to be a pump and dump or a dump and pump? Time will tell. 23 seconds. 23 seconds. So spiders are seeing a little bit of weakness. You're starting to see some 8 seconds here. Oh, spiders are dumping, triggering that head and shoulders. For they say the first move is the wrong move. Let's see. We have not got a daily close yet. All right, quarter bit raise. Spiders rallying. Spiders rallying. Get ready to potentially short this market. I want to see a little bit more upside. Here we go. Spiders are ripping. The dollar's falling. Remember, more volatility creeps in. All right, guys, I'm shorting NEO here. NIO, it's a 1/4 position. I got filled at 13.17. 13.17 on NIO. It's a 1/5. 13.17. I have 1,000 shares of NIO. I'm going to put a tight stop loss on this trade. Basically, at 13.39 is my stop out. I will be prepared to add to my position at the test of that double top, and if we get a 5-minute close outside of this band, I will stop out. Spiders right now are still trying to push. We are short NIO at 13.17. 13.17. I'm also looking at shorting the regional banks here. I'm going to pull off the regional bank short. I haven't been filled yet. All right, I'm going to short the regional banks here at 48.66. 48.66.
Let's get down to business.
So markets are rallying. Nile's trying to push up here. NIO.
If you're living life to the max, say yeah. If you're making money for the fam, say yeah.
If we test this double top on NIO, I am going to execute a second short. NIO is trying to pop up. VIX is dropping. Oil is flat. Apple's had a nice little bounce. Microsoft's still muted. Google's still holding well. Small caps are trying to bounce here. Let's see what's going to happen here. The spiders are really fighting this level. And if we get a push to this gap fill, that's a decent area. All right, I'm going to put a stop loss on NIO at 13.45. 13.45, hard stop. Here we go. So the bigger reaction typically comes when Powell is here. So we're just short NIO and we're short the regional banks here at 48.66. Short regional banks at 48.66. These are just day trades, tight stop loss. Stop loss on the banks at 48.91. Stop loss on NIO at 13.45. Let's see if we can get some downside. The spiders are still fighting here. Big volume coming in. Big volume coming in.
If you're making money for the fam, say yeah. If we hold it down for the gang, say yeah. If you feel the pressure, someone say yeah.
NIO's still just at our level, holding well. Apple's starting to come in a little bit. It's going to weigh on the spider ETF here. Google's strong. Microsoft seeing some weakness. Nvidia's pulled off of it a little bit from its initial pop. All right, NIO's trying to push up. NIO is pushing up. We're slightly out of the money on that trade. But I will add again at the double top. You can see on the daily chart, we're very, very extended on NIO. We have some pretty decent resistance at these pivots. There's that gap fill. 1340, which we could maybe want a Pearson fill. Spiders are trying to push up. Apple's remaining strong. Gap fill on NIO is 1340. I will add to my position there. All right, and really at 2:30 we have Powell coming out, and that's typically the bigger market moving event. Small caps, dollars dropping substantially here. The yields market has cooled off a little bit. Let's look at some of the high flyers today. XPEV is another one that had a terrific pop. Not really interested in doing anything there. Teladoc Health. Let's take a look to see what TDOC is doing. This one's looking a little bit tired in my opinion. This one's another short opportunity. It's testing that pre-market high, that yellow line there. So Teladoc is a potential short at these levels as well. I wouldn't chase it much higher once it's popped 24%. All right, guys, I just grabbed some TDOC short here at 28.39. Short TDOC, 28.39. Short TDOC.
I thought it would be nice to do a little mix, short mix. I'm sure my brothers have you covered with some classics, a journey to run.
So we're short TDOC. Now I'm going to do a tight stop loss on TDOC as well. Basically, the stopping out at this pre-market or this high pivot today.
Yeah, I'm just going to play some trance, try and set a mood, kind of describe our current state of mind for you, and play a song at the end that I'm sure you'll all grow to love. So, with that being said, 100 episodes, 1,000 more to go. This is Fridays, Ref 1, Fridays you that I know.
All right, so we're short TDOC here, which has had a nice little rally. Spiders are still fighting this level. NIO we're short 2 cents, basically out of the money on our trade. TDOC is trying to push up. Now, if this fails to make a higher high, closing basis, we could have this potential little topping formation triggering on TDOC. Seeing more weakness in Apple. Microsoft's flat. VIX is still flat. Spiders are still trying to hover. Really, it's kind of a muted price action day. It's very, very quiet in terms of the initial reaction. We're seeing NIO maybe come back down. We're seeing the regionals still softening up a bit, but the regionals are at this previous pivot high here, which is holding support at the moment. And then we have Powell in 22 minutes. So we're in 3 positions, short regionals. I'm actually going to move my stop loss on regionals down here, just so that we protect the trade a little bit more to 48.82. So I've just tightened up my stop on the regionals. And we have a starter position in NIO, starter position in Teladoc. Spiders are trying to push back up here. So we're just seeing the markets trending higher, but still very range bound. It has not made a big move. The yields, after having an initial dip, are trying to push back up. Take a look at the 2-year yield here. So the 2-year yield, let me just pull it to the hourly chart, had that initial wick down, and now it's trying to push back up. So it almost looks like it wants to fill this gap here on the upside target. So we'll see if it starts to push back up. Teladoc's pushing. Spiders are pushing up nicely here. I'll add to my Teladoc position at this high here, at this double top. Regionals are trying to bounce with the market, but still acting weak. So right now it's still range bound, the markets. No real big movement as of yet. So we're seeing the SPY still trying to push up. It looks like it might want to hit that gap. Markets are trying to push up a little bit here. I'd really want to see Microsoft start to participate in this rally. That's how you're going to get a bigger move. So the small cap IWM is pushing up a little bit more now. Let's go back to the 5-minute chart on the regionals. So this just seems like it's a mega cap tech that's lifting this rally. Spiders, Qs are catching a nice little bid here. So the VIX is still flat. Natural gas took a small dip. Oil still down. Spiders are still trying to push up here. Let's look at the 5-minute spider chart. Looks like it wants to hit and charge for this gap, sitting at 455.44. NIO's still really just muted. Regionals are pushing up. If Teladoc comes up into this double top, I will add to the short. Same thing with NIO. There's a gap fill sitting at 1340. Seems like the main stock that's lifting this rally is Apple and Meta and Amazon. They've had some nice boosts. Tesla just turned green, red to green on Tesla, so that's a positive move on Tesla. Tesla's turning green here. We'll see if it can hold most of the gains. Look at the QQQ. Google's still hugging that level. It hasn't really made a new high since this morning. The Qs are trying to break out of this. Now what I'm watching for on the Qs is, does this inverse head and shoulders fail? This is a little inverse head and shoulders pattern that is technically bullish, but If it fails, this turns into a very bearish pattern. We haven't confirmed it yet. Just erase a lot of these lines. Mega cap tech is trying to lift this market. Look at the KRE. So KRE is basically flat on our trade, coming down a little bit. Google is having a pretty sharp reversal. Google's coming down hard right now. After being strong all day, Google's had a nice little 5-minute sell there. And this one, if you get a close at the lows here, below 129, this white trend line, that is not a good sign for Google. But right now, it's holding up okay. Regionals are still coming down. We're flat on that trade, flat on NIO, slightly out of the money on TDOC. Spiders are seeing a little bit of a reversal on the 10-minute chart. You see getting rejected at the same resistance that rejected us early in the morning and then initially in the morning rally, right off the 20-minute open. You have this little M-top pattern on regionals that hasn't triggered, but maybe, just maybe, here's your M. Downside target, if it gets a close below that neckline, takes us down to about 48.25, which would imply a drop of about 40 cents. But right now the markets are okay. Things are holding up okay. You're seeing Nvidia trying to push up a little bit. Again, Mr. Jerome Powell speaks in roughly 14 minutes, and he is the market mover. Certainly is. I haven't looked at gold. What is gold doing right now? I'm sure it got an initial pop. You see, even gold's reaction is muted. Very, very muted. So the dollar initially had that dip. It's trying to rally now off of the lows. So a huge red candle down. Now it's catching a small little bid. We'll see if it can recapture the positive side. But rates have been raised. So we're now sitting at a Fed fund rate of 5.2 to 5.25. Sorry, 5.25 to 5.5 on the Fed fund rate. All right, regionals are trying to push up here. I'm very, very range bound. This is the range we've been stuck in all day. Which way is the range going to break? You can simply draw your parallel channel, and that's really the range we've been stuck in all day. High, low, high, low, high. Very choppy session. That's what typically happens on FOMC days. All right, I'm seeing Apple reverse pretty hard here. That's going to be very, very heavy for the market. You're seeing AAPL getting some sell side pressure. Technically, it's been one of the stronger mega caps. So if Apple starts to break down today, that's what's going to push this market to break this lower boundary range. Apple is one of the strong mega cap stocks today, that have been holding up pretty well on the back of Microsoft's weak earnings reaction and miss on earnings. Regionals are still holding up okay. NIO were flat. Teladoc were basically out of the money by 15 cents, 20 cents or so. Bitcoin price action softened up, still trading under 29,300. NIO, we're now in the money. We are now in the money on NIO. I still think this can have a sharper drop down to pierce that 13 level. That's what I'm expecting. I'm seeing the yield market move back up now. I'll take a look at MU, Micron. Micron's been putting in this typical bullish structure. So you had your initial bull flag break here, breakup, consolidation, another breakup, and now you're just holding this high. So you want to see it really maintain this high pivot. If you start getting some closes, some 5-minute candle closes below this key area, it means you could come back down to the low end of the range. But there'll be some decent support at this wide range green bar breakout. But right now on the daily chart, NIO, let me just erase everything. Ooh, this looks actually poised to break out here. This doesn't look bad. Good find. So just give me a second with this. So we're getting above all the daily moving averages. That's positive. Obviously, MU is part of the semiconductor space. So the only thing that I'm seeing resistance is this key trend line, which does imply you have a little bit more upside. Now, you could get a push all the way up to about challenge this red bar high. You need a daily close above that for this bullish pattern. You get a daily close above that level, and MU looks like you'll probably challenge the previous highs up here at 74.50. But that's a pretty good find on the trade. Nice spot. Obviously, it's super risky. How I would play this one particularly, let me just do it as a day trade. So it's up 2.65%. Just going to tighten in the candles here. All right, you could play this on the long side and just either use this wick low as a stop out, 67.12, or this wick low if you want to give it more room. But it's not a bad chart right now. It's actually looking quite positive to move higher. You know what? Let's try it on the long side here, MU. Especially if the spiders push up. Obviously, it's super, super risky ahead of Powell. I'm going to stay away from this trade right now as I'm managing a few other positions. But that's a decent area. You know, you really want to hold this if you're bullish. This is the range, right? You're kind of chopping in the middle of the range. So it's hard to buy this range because you're literally just in the middle. So it could go either way. It's kind of a 50-50 for a day trade. I hope that helps, Sudden Python. Are you looking for a swing trade? Again, swing trades and day trades are very, very different how you play them. I wouldn't jump in on this yet. It would be a day trade if I were. Spiders are still trying to push up here. Spiders are now coming down here. Micron's falling. Let me look at my regionals here. KRE. So KRE is looking weak as well. This one's looking a little bit brittle. So we're in the money on our NIO trade on the short side, slightly out of the money on Teladoc, flat on KRE. Watching this MU trade. One of the viewers brought it up. It's actually a decent chart on the semiconductor space. You got to want to watch the SMH as well. I wouldn't play Micron. I would only play Micron if we got a breakout out of the 67.45 high, or if we got a flush down to support here, and then you just keep a very tight stop loss. That's the only way I would play Micron. Spiders are still trying. And remember, we have Powell. We also have huge earnings after the bell. Meta. All right, TDOC is starting to come in a little bit. Market's still range bound. Really, the spiders hit the low end of the range and are now trying to push to the high end. Here comes NIO. Let's see if we get this range break. We're going to need some market weakness. I'm seeing the dollar push up here. So the DXY has pretty much recaptured all of the dump that it had initially. That's not typically going to be positive for equities, this is why you're starting to see that sell-off in the spiders, is really only because of the dollar trying to recapture its key trend. Spiders are dumping out now, getting a little bit heavier. The plan to do these trades is once we move into the money a little bit more on, say, NIO, we'll start protecting the trades. Same thing with Teladoc, same thing with the regionals. We're basically flat all the way around, and spiders are still range bound. We have the 2-year yield pushing up here. So the US 2-year yield just made a new high after it had that dump. That's going to be bad for mega cap tech and small cap stocks. You should see the Russell and regionals react. So look at this 2-year yield. We just made a new daily high, and we're charging that gap fill, which is what we discussed in the video a few minutes ago. So now on the daily chart, if we look, if we get a range break out of these pivots, I mean, really the next resistance is your all-time high sitting at 5.1. And that's really going to narrow the spread between the Fed fund rate and the 2-year yield, and that's going to make Powell more hawkish. Once that 2-year yield starts to creep up a little bit more, that's going to make Powell more hawkish. Here comes a range break on the spiders. Here we go. Regionals are softening up. So spiders now testing the low end of that range. Also the neckline, a major neckline of a head and shoulders. If we get a trigger of that head and shoulders, we go down to 451.56. TDOC, we're in the money. NIO, we're in the money. Nice job. KRE, we're in the money. So 3 of our trades are all in the money right now. Let's start protecting NIO. So I'm going to move my stop loss on NIO down to 13.27. It's not in the money yet. 13.27 TDOC just went in the money. And again, if the regionals trigger this little M top, we also have a nice move down to 48.25. All right, NIO, I'm going to put a break-even stop on NIO. So we're looking at 13.17. 13.17 on NIO. We're protecting the trade. We are in the money right now. So that's great to see. NIO. Protect the trade with a break even. We'll see if it pushes up and stops us out. At least we know it's risk-free. You also have support, which we should flush down to on NIO over here. This new little trend line. If we lose this wide range green bar breakout, this becomes a failed breakout. Spiders catching a big bid here. Regionals are pushing back up. So is TDOC. Maybe that was just a fake out, shakeout, and then it pushes up to gap. We'll see. All right, I'm going to move my stop loss up to 13.16. So we're just going to make 1 penny on the trade. At least we're in the money, and we're protecting the trade on NIO. So I move my stop loss to 13.16. KRE is starting to get a pop here. Yields are still acting well. Spiders caught a nice bid here. Teladoc's catching a bid. I'm seeing the VIX trying to catch a small little bid. Still weakness in Amazon. Weakness in Microsoft. Regionals are trying to push back up. It's going to be positive for the markets. We have Powell in 2 minutes. NIO's starting to drop a little bit more. I may play the press conference. So I'm going to stream the FOMC meeting. You should be able to hear it. We will be playing PAL right now. It's just music. Bigger volume starting to come in. All right, Pal's about to walk on the stage very, very soon here. Very soon, Pal's about to walk on the stage. I will be streaming in the background, and I'll be calling out my trades simultaneously. So we've protected our NIO trade with an in-the-money stop. We're slightly out of the money on KRE. All right, here comes Pal. So regionals are trying to take a step down here. Regionals are softening up some more. Pal's late. Going to make the markets a little nervous. All right, he's here.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price
Regionals
stability,
are dropping.
the economy
Regionals are
doesn't
dropping.
work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 0.25 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year.
Spiders are ripping.
Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight.
Still range
Over
bound.
the past 3 months, job gains averaged 244,000 jobs per month. A pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers.
I'm going to add to Teladoc at the double top.
Remains well above our
Sure.
longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%.
Heavy volume on regionals.
The core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks.
I just added to T-Doc short at 28.65.
Inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermediate
Spiders just filled the gap. We'll see if it holds or reverses from here.
Economic activity remained resilient. Job creation remained strong while cooling a bit, and the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance.
This is a mega cap push. This is a mega cap push.
We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting. And how we're thinking
big
about
rally on the spiders here.
But we're now mainly thinking about the next meeting. I will also.
I'm going to add to my TDOC here. 28.74.
We get 2 more job reports, 2 more CPI reports.
We got stopped out of NIO with a small win
this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting.
Spiders pushing higher
We're
here.
Making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
Big push on the spiders. It's very, very, very dovish.
You said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of
My
the
average
committee
on
to warrant
TDOC is
necessary?
28.50.
I'm just going to go back to what I said.
Big push on the
That's the
SPY
question.
here.
We have 8 weeks
Range
now
break.
until the September meeting, and all that
Next
data that I
resistance
said,
is
we're going to
double
be
top.
looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And you know, we've seen this before in the data.
Dollars dropping,
Many
yields are
forecasts call
dropping,
for rates,
volatility is
for inflation to
dropping.
remain low, but we just don't know that until
Big
we
push
see the
in
data.
mega
So
caps.
we'll be focusing on that.
Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. You know, we've seen the Barbie movie numbers.
So I'm going to add to my KRE here at 48.87.
It seems like the American consumer is in pretty good shape, and it does seem like growth is sort of picking back up a little bit, or at least doing well. And I
Brings
wonder,
it up
from
to
your perspective,
48.76.
if that continues, if we see growth not just stabilizing but doing, you know, performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way: the overall resilience of the economy, the fact that
So spiders
we've been able
tested
to
the
achieve
highs.
disinflation so far without any meaningful negative impact on the labor market, the strength of the economy overall. That's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Big market push. Big market push here.
Thanks, Chair Powell. Neil Irwin from
We'll see if it can
Axios.
hold these gains
so,
and trend higher.
In the intermeeting period, soft CPI, jobs reports, still strong but moderating. JOLTS look good.
TDOC stop out is
So if you're data dependent,
29.40.
why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to
So the yield
what we're
market
trying
is
to do here,
dropping
we're
quite
trying to achieve a
substantially.
stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote
Big
down
volume
our
coming in.
individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the interim.
Gold is moving up a
data,
little bit.
and as I mentioned, broadly consistent. Not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's, you know, a labor market that continues to be strong, but gradually
We have
slower.
meta earnings after the bell.
I mentioned that the inflation report was actually a little better than expected, but you know we're going to be careful about
KRE is
taking too much
acting
signal
strong, making
from
a new
single
high on the
reading.
trend.
And you know, growth came in
So
stronger.
that
than
pattern
expected.
is now
So
negated.
that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants'
This
inflation
is a big
forecast
reporter.
from June
Nick
for the fourth
Timmeros,
quarter of this year will be
Fed's
too
whisper.
high, given autos and shelter. That by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough?
So we're slightly out of the money on
to hold rates
TDOC.
steady from here, or do you
Slightly
need
out
to
of the
see
money on
below-trend
regionals.
growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, you know, how much of this and how much of that. You know, we'll be looking at everything, and you know, we'll be looking to see whether the signal from
A little bit of resistance at this double top, heavy
is
volume
replicated
coming in.
or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had
Regionals are acting strong because the yields are dropping.
That slower pace and defer until the fall any decision on whether you need that second rate?
Microsoft's still down
So I'm just going to
3.85.
tell you again what we're going to
Let's
do.
see if
In
Microsoft
September,
can get
we're
a
gonna look
range
at
break out of this.
2 additional job reports, 2 additional CPI
Bearish
reports,
consolidation to match
lots of
the S&P
activity data.
500.
And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten
So
further?
notice how the
If we
SPY
get that
broke out of
signal
its
whenever we
bearish
get it,
range,
and
but
that's the
Microsoft
collective judgment
hasn't.
of the committee, then we
You
will
need
look at it. If we
Microsoft
don't,
to break out
then,
if you want it to go
we'll
higher
have
than
the
this.
option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
So regionals are very
Hi,
extended on the
Chris
daily.
Weaver, Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation? At its
Small
current
caps, the
level, headline
IWM's
level of
ripping,
3%?
pushing higher here.
And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say
So
that having
perhaps
headline
regionals
inflation
want
move
to
down
go
that much
to
almost creates it will strengthen the broad
right
sense
there.
that the public has that inflation is coming down, which will in turn, we
So
hope,
that's your resistance
help
on
inflation
regionals hit.
continue to move down. So you were really sorry. Well, your question was.
Well, I mean, you've talked for many
Microsoft
press
seeing some
conferences now about
weakness.
the
Spider's
harm
seeing
created
some
by
weakness
inflation, how
now.
hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly
Spiders are
face
still
that
trying
risk.
to push up here.
But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think. That's core.
So spiders are seeing a little bit of resistance here.
And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated.
Talking about the inflation,
So we think
core
we're going to stay
inflation.
on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a
So the
little
2-year
bit
yield
more,
has dropped to
how
4.85.
much of an increase in unemployment do you think
Still
is
above the key
acceptable
daily
to
moving
get
averages.
that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March.
Microsoft seeing more weakness.
3.6%. So that's
Apple's
a real blessing.
holding
We've been
okay.
able to achieve
Google's
some
holding okay.
disinflation. And we don't seek to it. It's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that.
Do you have a potential 10-minute topping tail forming on volume?
Inflation is volatile. It interferes with
10-minute topping tail on volume coming in.
That's the thing we really need to avoid and will avoid.
Heavy volume.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now? Is the economy still moving in a direction where it creates
Markets
more
are bouncing
inflation?
still.
People
Got
talk
30
about
seconds in this
base
candle.
effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating? And you're able to go back to the old Fed policy of opportunistic disinflation.
Microsoft's still stuck in a range.
So I'll just
Notice
say,
that divergence.
again, the broader picture of what we want to see.
Spider range break. Microsoft
we want
range
to see
rejection.
easing of supply constraints and
Carrie's
normalization of
acting well.
pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. And what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Markets are still holding up okay.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so
big push on the S&P 500.
I mentioned before, it's possible that we would move it consecutive. It means we're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. So among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it
I just
used
added
to,
my
but that doesn't
KRE short here,
necessarily change the process
49.17.
from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags plural that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restricted until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation repeatedly has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really
This is a very important question.
Rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response to fiscal monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned.
Microsoft's starting to weaken.
For goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. And take autos as an example, the combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down clearly.
Ooh, big drops on Teladoc here. We're in the money just like that.
I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
See, and just to follow up, do you think that
big
of those
drop,
two sources,
big buy,
the
run the
core will rely
stops,
more heavily,
get the limit
let's say,
orders in,
impact
and then
from
sell
rate
into
hikes,
them.
or
That's the strategy
more
likely
easy
this.
too?
I think monetary policy is going to be important going forward,
Either you
because
flush
we're
stocks and
sort
push
of
it higher,
reaping now the benefits
or there were a whole bunch of limit orders.
of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Thank you, Chair Powell. First, let me compliment
So
your
Microsoft's
choice
still
of
weakening
time.
here.
So
At a pretty
thanks to
big
your
important
question. So the
level.
Beige Book, it said input cost pressures remain elevated for services firms, but ease
Starting to
notably
see the
for
spiders come down a
manufacturing
little
sectors.
bit
That
more
an
now.
indication that
Microsoft's
there's
getting
a
heavy.
wage inflation pressure, and how do you target pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication.
Microsoft's getting very heavy here.
And shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time.
See if we get
2%
a
inflation.
top and tail on this KRE. Right now it's
and by
not.
so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing.
No
you can look at
top and
job
tail.
openings coming down. You can look at just job creation in the
You almost got a failed breakout on TDOC.
It's still at a high
Looks
level.
like.
It was at really
Still has a
extraordinarily
chance.
high level for most of the last 2 years. So you see cooling, particularly in private sector, in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you take both into account. I think you take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, but what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be
just
this year.
Hit a big technical support level.
But many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
The dollar's hitting support. This is a big level.
A good part of Wall Street has become more confident
zone.
that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So
fighters are weakening a little bit.
It has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of I think constructive diversity of opinion that helps us make informs our deliberations, helps us make I hope better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say though that there's a pathway, and yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical records suggest that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Jeff.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com.
Right.
You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%. That as long as
So
you
we're
see
now
continued
testing the
progress.
range
I'm wondering,
breakout.
how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea
Big
that
level for the SPY here.
until inflation gets to 2%,
Testing the
would be
range.
a prescription of going way past the
Breaking
target.
the range.
That's clearly not the appropriate way to think about it. So
This could become a failed
in fact,
breakout.
if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year.
Microsoft's testing an important level.
The federal funds rate is at a restrictive level now.
Nvidia,
So
Apple, mega cap tech's getting hit now.
Credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would.
Spiders are
be very
back in the
careful
range,
that we
all
really
day
want to make
range.
sure that inflation is coming down in a sustainable level. And it's hard to make.
Hitting
I'm
support.
not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you
This
got
could
to
be a
2%
nasty
inflation.
hourly reversal
And
candle.
you'd start cutting before you got to
22
2%
minutes
inflation
left.
too, because we don't see ourselves getting a 2% inflation until all the way back to 2 until 2025 or so. So
Microsoft's looking to break. Big spider dump there. Microsoft's breaking the daily range, going to test the lows.
Yahoo Finance. It's been over 4 months since a handful
Look at
of
this
regional
spider
banks,
sell
including
now.
Silicon Valley Bank, failed. When you look at credit conditions now, given Bank
Big
of
spider dump.
California's acquisition
Spiders
of
are negative.
West, does this acquisition
SPY is at the
suggest
low end of the
full
range.
impact has not
We're
been
now in the
felt,
money on our KRE.
or are you comfortable saying that we've seen
There we
most
go.
of the ripple effects that may have occurred at this point?
Turning this down
And how
because
does
things
this
are getting
play into your
interesting.
outlook for policy?
So I didn't want to
Full
comment on
round
any
trip.
particular merger proposal,
Looks
but I
like a
will
failed
say,
breakout.
things
We
have
could
settled
break
down,
this range.
for sure out there.
This downside target of 451.60 still in play. Regionals were in the money. TDOC were out of the money.
Is up significantly year
Microsoft's testing a range break.
sector profits generally.
Apple's had a nasty reversal on the hourly.
And overall, the banking
Same
system
thing with
remains strong and
Nvidia,
resilient. Of
Google.
course, we're still watching, the situation carefully.
Look at this nasty hourly
Monitoring,
candle forming. If
the
it holds,
monitoring
that's a
conditions
nasty
in
wick.
the banking sector. In terms of the actual effect.
Not good price action for the spiders.
A particular set of banks.
This
that
may
were-
be a failed
that were
breakout. Here we
affected because of
go.
their size,
New lows on the
business
day.
model, things
New
like
spider
that.
lows
They
on
were
the
more
day.
affected by the turmoil in March than others. It's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So
Small caps
I
are holding
I
up
think
better.
We have to take a step back from. I
Having
can't
the VIX
separate
pop up
those
now.
anymore. I think basically
Big reversal on
we're
Meta.
just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
Another dump on the
So I think
spiders.
that is an expected result of tightening interest rate policy. Is that bank credit conditions bank lending conditions would tighten as well. And
This
so
is
the
a
question
full
is,
round trip
is
on
it-
the
is it
spiders.
more
Not
effective
looking
this time
healthy,
because of what
but we
happened
are
in May?
holding
I just don't
the
think
low
we
end
know
of the
that. I
support.
think
This is
we're
technical
looking at the
support.
current
If we
data
break it
in GDP,
and
we're
get a
seeing strong
close
spending, we're seeing a
below
strong
this
economy.
pivot, this reversal
It's made
pivot,
us
we're likely going to test 451.60.
raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching.
Look
it
at the
carefully
upsloping trend line we're testing,
and expect to continue to do that.
going all the way back to the 17th of July. It's a
Hi, Chair Powell.
big
Thanks for
level
taking
of
our
resistance
questions. Megan
now.
Costello with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued
Can
strength.
Microsoft reclaim this trend line? That's big for the market.
Well, wages in excess of inflation.
Spider chart and the Microsoft chart look very similar.
Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time.
Trying
As
to
I
hold that
mentioned,
range.
nominal wages have been coming down gradually.
We could test the high end of the range here at 455,
Expect to see more of that.
but this reversal is not
consistent
healthy.
over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so.
This reversal likely means more downside.
I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down.
Regionals are okay, bouncing off that previous high.
To keep rates elevated or to raise
Now it needs to make a higher high in the trend. If it doesn't, you're going to test the low of the range.
To us by Congress to get inflation under control, and we think
Markets look weak right now.
The most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price
But
stability.
that trend line that you're hugging on the SPY,
thing we can do now.
that becomes a nasty failed breakout.
I would just point out that the people who are the
If it
most hurt
closes
by
below.
inflation right away are people who are on a low fixed income, who, when you're talking about travel, transportation costs, heating costs, clothing, food, things like that. Those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So
Spiders are seeing more sell side pressure.
The record is clear that if we take too long,
Getting rejected off this key level.
if we don't succeed, that the pain will only be greater. So
Hasn't lost it yet, but it's close.
We're doing.
We got 45 minutes left in the trading session. Will the indices finish negative, and will they make a new daily low?
This meeting this week was going to be a live one. In the event,
Or will this range hold? We've been chopping in this range all day. Had an attempt at a breakout, made a new little cycle high, and then failed and reversed.
Changed from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, I mean, you could. Was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that there's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
That's the hourly reversal on Apple.
Financial conditions.
Good volume, 15 minutes left.
Steady clip in recent weeks, the dollar, the stock market, etc. What does that mean for the Fed and being sure that inflation will come down to target?
The Qs are hugging this intraday 1 hour 100 moving average. But you've tested it a few times here, a few times here. Odds are you break it. There's a big gap fill sitting at right around here.
Use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down. And in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately over time.
See, the spiders are fighting here.
Where we need to go.
Fighting this longer-term resistance trend line. You can see it on the hourly.
Do you expect the Fed
Will
to
we
cut
break?
nominal rates next year while also continuing QT?
Apple's coming down. It's going to weigh in on the market.
Is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it, you depending on where you are in the cycle. So there are two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Thanks, Chair Powell.
Heavy volume on this hourly candle.
I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it.
Thanks. So that's a very important thing, yes, and yes to both sides of that. Yes, banks are
Spiders are still bouncing,
working to see that they are ready to use the discount window, and we are strongly encouraging them to do that. Banks broadly. We did find, as you know, during the events of March, and that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Possibly more banking issues coming. Discount window, easily accessible.
You talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance or lack thereof right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting
Nvidia is seeing more weakness? So is Apple.
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes,
Teladoc's moving up.
There are many people who have low rate mortgages and
just made a new high.
They might want to sell in a normal situation. They're not going.
Spiders look like they're coming down some more now.
Mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot
about
of supply
to test the lows on the spiders. Will we make a new daily low?
And a lot of the buyers are first-time buyers coming in and buying it, with these relatively elevated mortgage rates.
New low on the spiders.
This will
there
take
it is.
Some time to work through. Hopefully more supply
All right,
comes online.
triggering the head and shoulders pattern.
We work through it.
Potential in 1 minute.
Through the
hasn't triggered yet.
Of the pandemic.
It's on watch.
We'll go to Nancy for the last question.
Our KRE trade is in the money.
Nancy Marshall
I'm
again,
comfortable
sir, with
holding this one overnight
Marketplace.
as a swing
Russia has pulled out
due to how
of
extended they are.
allowing shipments of grain, safe passage.
Russia markets
through
didn't
the
like the
Black
Russia
Sea.
talk. New
Alternative
lows on the
routes at this point
spiders,
could
in the
be
money
closed
on the
off.
KRE.
Just wondering
Just need Teladoc to
how
cooperate.
would that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now.
Spiders are recapturing that low. They did not trigger the head and shoulders. I repeat, they are still okay. All right. Fed meeting is over. Let's see how the markets react with no more commentary. And we'll see if they can actually break down here, the spiders, or if it can maintain this range. But they are looking weak. Microsoft's trying to move up. Heavy volume on the KRE ETF. Heavy volume on the KRE ETF. The spiders are still holding the low end of the range here, maintaining the pattern that it traded in all day. But this reversal is never a good sign. We'll see if it gives up more of it. Microsoft's recapturing that key little trend line break that it just did. A 5-minute close would be much, much more bullish. Apple still has a nasty hourly reversal. Gold is up a little bit to the 1974 level. Google's trying to fight that 129 level. Now, Google's at a critical inflection point because the markets have been strong today because of Google, but now it looks to be trying to lose that key 129. This is the big level for Google. Does it get a daily close above or below this pivot? So if it gets a close below, it does not. It could mean a potential failed breakout. And that's never a good thing, especially when the breakout attempt is on the back of a strong earnings reaction. So that's a big level for Google. We'll continue to maintain it and watch it. If it does have a failed breakout, it likely means we could fill the gap in the coming days. So watch Google closely. Spiders are back under that key trend line. Let's flip to the 10-minute chart on the SPY. We're still short KRE, which I'm comfortable holding overnight. We're still short Teladoc, which is slightly out of the money. I'm going to erase this trend here just so we can see this level on the SPY that it's fighting. Long upsloping trend line. And one could arguably say there's also potential head and shoulders that it's fighting here. Your little left shoulder, head, right shoulder failure. Spiders are trying to fight though. You're seeing volatility trying to push back to the green side a little bit. Google's still fighting here. Microsoft, Apple still holding on. So right now, Spiders are trying to clear it above this key trend line, but you can see it's struggling. The longer it struggles, the more weakness and the more likely it is that we go down on the charts here. I still have a downside target of 448. I don't know if we'll hit that today. It would take a pretty big late day flush in order to do that, but you never know. But policy is firmly in restrictive territory according to Powell and the Fed. And we still have earnings after the bell. There's a big earnings after the bell is Meta. Meta, ServiceNow, they're the big ones after the bell, and Lam Research, and O'Reilly Automotive, Chipotle, Edward Life Sciences. Spiders are still fighting. They're managing to hold. Regionals are back at that previous high. This level is just like a little magnet for the S&P 500. So we're short Teladoc, we're short the KRE, watching Google closely. Spiders are still trying to hold and fight this level. As of now, this is a little micro bear flag forming, but you are technically speaking at support. Bitcoin's caught a nice bid, trying to push up. Seeing the small caps trying to push up some more. So Powell overall, markets initially took it positively and then rejected it. basically sending us back to the low end of the range. This is the market open where we gap down. Just been trading in this pretty much all day long, this range. And now we're at the low end of the range, trying to hold on, but this is potentially a breakdown point in the SPY. What's keeping the markets up is the strength in the small caps right now, IWM, and Google strength. But Microsoft's looking weak. Let's do a quick peek on Tesla. We have 30 minutes left in the market session. I'll stay on for a few more minutes. But so far the reaction to the hike is a lower in the two-year yield. Two-year yield fell from roughly the high of 4.92 down to 4.84. Pricing into the bond market may be saying the Fed is slowing down. And then you also had the dollar fall. So the dollar fell, the yields fell despite the raise. Regionals rallied, markets initially rallied, and now they're right back down. The spiders is negative by 0.24%. Nothing crazy yet. Regionals may start softening up a bit more. We are in the money on our regional trade. All right, on the regional trade, I'm going to say protect it with a break-even stop loss on the KRE short. So break-even stop loss on KRE. Teladoc, we're slightly out of the money. Still very, very overbought. You're seeing Google trying to potentially close below that 129. That's a huge level. Spiders are also trying to come down a little bit more now. Let's take a look at our hourly candle, which is always important on the SPY. We got this huge distribution doji, and now we're coming back down. So we'll see if this bear flag triggers and takes us lower. If this bear flag does break to the downside, we're looking at a move of basically 452.27. Let's mark that off on the chart. But right now you're still holding the technical low end of the range, which has been good support. So until you trigger and break this, you have to respect the support level that we're at. Meta after the bell also could be market moving. Let's look to see what Meta expectations for the street is Meta to beat. And I think that there's have a good shot of that. Nonetheless, Meta is still overbought on the weekly chart. Very extend on the weekly, but you've never really filled that official gap to the upside on Meta, which leaves me a little bit suspect that you could potentially challenge that area. So spiders are maintaining and holding. Meta's up nicely on the session, rallying 1.5% into its earnings call. It's always interesting to see a company rally into its earnings. Typically, companies that rally into earnings fall. Typically, companies that fall into earnings rally. So we'll see what happens here on Meta. Regionals are softening up a little bit. Microsoft's pushing up. That's going to be healthy for the broad market. Microsoft's getting a nice oversold bounce. But you're starting to see Apple see some selling. This is potentially a failed breakdown. So we dipped, got a 5-minute close. Now you're rallying. You really want to see a 2 5-minute candle close to negate this breakdown. All right, we're still holding the low end of this range that we've been stuck in. Let's draw our range back in again. This is what's kept us in check pretty much all day. Little blue range. Went above it, went below it, now we're back in the middle. Kind of this equilibrium. For every reaction, there's an equal and opposite reaction. So we had a big pop, we had a big drop. Now the markets are settling down, digesting things, and starting to push up a little bit. Let's look at that Micron trade, see if it broke out. Yeah, that Micron trade, look at that nice little breakout. Could be a failed breakout. You have to watch that closely. Gold didn't really have too big of a move to the upside. Small caps are the ones that are benefiting from this. Spiders are at a confluence of moving averages. We have about 24 minutes left in the trading session. And so far the SPY is negative, the Russell is positive, and the NASDAQ is negative as well. Right now the Qs are down 0.5 percentage point, so mega cap tech is lagging despite the strength in Google and Meta and Apple. Just clearly the weakness in Microsoft. All right, carry is dumping, so we are nicely in the money here. What I'm going to do is now move my stop loss up to 48.88. Protect the trade, at least 5 cents in the money on that trade. So 5 cents in the money, protect it. All right, we're falling more on the KRE. We are falling more. I'm going to lower this to 48.85 now, protecting the trade. We just need Teladoc to cooperate, and then we would have been 3 for 3 on this FOMC, but it hasn't been an easy one. It's been very choppy, up, down, all around, sideways. So at least the KRE is risk-free. Teladoc's coming down. Hopefully we get a big drop on Teladoc. There's been some hard drops, so this one could see some big wicks down. Big, quick wick down. Spiders seeing a little bit more sell side pressure. Just want to see the daily volume today on the SPY. For an FOMC day, it's light. It's actually fairly light, but it could be a potential daily topping tail as well. Carry's coming down some more now. You're seeing a little bit more of the strength coming in tech. Spiders are catching a bounce. Carry's bouncing. We may get stopped out of KRE, but it would be an in-the-money stop. Google had a pretty big bounce, holding that 129.05 level well. Take a look at Google. Google saved itself. That's a pretty good save by Google for now. Will we see a late flush in the market? Because we are still inside of this bearish wide range red bar. But right now you're going to be going to the top end of the range, it looks like. Meta's moving up nicely. The last 4 hours have been upside. Microsoft's pushing up back to the high end of its range. So are the spiders. It's kind of trading in tandem. I just got stopped out of KRE at 48.85. That's a small gain. 7 cents times 1,000 shares. Mega cap tech is getting a big push. I'm seeing the Qs, the spiders, they're all pushing. This is a potential short level on the SPY, 415 with a very tight stop loss. You can let it run to the high of this range. But markets are acting well, trending up now. All right, just in case we get a late day flush, I'm grabbing some more KRE puts here. Short KRE at 48.92. 48.92. Hard stop here at 48.99. Hard stop. Spiders are back testing the high end of the range. Crazy volatility, up, down, back to the high end of the range. So today you've hit the low end once, twice, 3 times, 4 times, 5, 6 times. This is where we found previous rejection. Will we see that again? KRE is rejecting at these previous pivots. Dollar still bleeding lower. Microsoft's getting a push, trying to break out here, out of its range. Big push in mega cap tech. Big push. So the spider's trying to push up here, trying to get a close outside of that range. Just teasing people. Looks like it might do it. And then some sellers come in, but we'll see. Basically right back at this gap fill. So Meta earnings after the bell will be big. Spiders are still seeing resistance at the top of that range. It's wild how that price action works. Is this going to be a lower high? Perhaps. Spiders are holding though. Microsoft's struggling at the high end of this resistance. Google, Tesla, Nvidia are acting well. Apple's acting astonishingly well. Apple's up 0.58% on the session. You have this negative divergence intraday on Teladoc. You made a new high on the today's cycle, but a lower high on the RSI. A little bit of a negative divergence. We have 12 minutes left in the session. The dollar softening up a bit. Regionals are going for more selling along with the SPY, pretty much a market trade at this point in time. Will they flush it or will they give it a quick pop? Or will they just keep us in this range? And we got Meta after the bell. Big report. So far, over 80% of S&P 500 companies that have reported have beaten earnings thus far. So clearly the trend is to the upside for beats in earnings. How's Meta doing? Meta's above the 300 level heading into earnings. A little bit of a dump there. Ten minutes left. Seeing Apple, seeing some softening. Spiders are coming down a little bit more now. Microsoft's falling, so is Apple. Meta's back under 300. Spiders are softening. There might be some potential selling into the close just due to Meta. People don't like the unknown. I'm going to move my stop loss on KRE to about 48.89 in the money. In the money on KRE. Let's just protect that trade into the close. Spiders are bouncing a little bit. I'm going to adjust this to 48.88. Spiders are still fighting the middle of the range now. So the spiders are coming down. Late little sell. A little bit of a sell coming. Still time for a bounce. Google's under that 129 key level. So that's a that's not a good close for Google right now. It's still got time to save it. Big volume coming in. Bigger volume coming in the markets right now. Spiders are set to finish negative unless we get a big pop. The Russell's set to finish positive, up 3/4 of a basis point, and the Qs are down 0.5% right now. So weakness in the QQQ strengthens small caps today. Very interesting. Very interesting divergence. Just got stopped out of KRE for a small gain there of 4 cents. Spider's catching a bounce. Microsoft's testing the high end of its bearish range. Apple's selling off into the close a little bit, so you're seeing money rotate into Microsoft, possibly out of Apple into the close. So you're seeing Apple coming down into the close, whereas Microsoft is rallying. You're also seeing Google selling off into the close, getting that bearish, what looks to be a bearish close. Oops, my apologies. My apologies. There are 5 minutes left in the market session. Just reconnect my screens here. So Google's coming down underneath that key 129.05 level. Meta got rejected at that 300 level, now trading at 297.98. KRE falling. Tesla's coming down. Google's saving itself here. All right, I'm going to wrap this stream up here. So a couple winners. I'm holding a bit of TDOC overnight into the close. But on that note, thank you all for tuning in, and we will